Season 5, Episode 10, The Six Streams of Investment Income. Throughout this season, we've explored many different kinds of investments: public equities, bonds, real estate, infrastructure, royalties, private markets, and alternative strategies. At first glance, the investing world appears incredibly diverse. Different industries, different structures, different markets. But if we step back and look beneath those differences, something interesting begins to appear. Despite the wide variety of investments, the income they produce usually flows through a surprisingly small number of economic channels. In fact, nearly all investment income can be traced back to just six fundamental streams. Six ways capital earns a return. Six mechanisms through which money flows back to the owner. The first stream is interest. Interest arises from lending. When capital is loaned to a borrower, whether a government, a corporation, or an individual, the borrower compensates the lender for the use of that money. Those payments form the interest stream. Treasury bonds, corporate bonds, bank deposits, private lending, all of these fall into the same basic category. Capital is provided today. Interest payments are received over time. The second stream is dividends. Dividends come from ownership in businesses that distribute a portion of their profits to shareholders. When a company earns more than it needs to reinvest in its operations, it may return some of those profits to the owners. Those distributions appear as dividends. Many mature companies operate this way. Utilities, consumer brands, certain financial institutions, some energy infrastructure firms. In these cases, the profits of the business become a direct income stream for the investor. The third stream is rent. Rent arises from ownership of physical assets that others use. A building provides space for a tenant. A warehouse supports logistics and distribution. Farmland supports agricultural production. Each time the asset is used, the owner receives payment. This is the rent stream. The fourth stream is royalties. Royalties come from owning rights connected to economic activity. A songwriter receives payment each time a song is played. A landowner receives payment when natural resources are extracted. A patent holder receives payment when a protected invention is used. In these cases, the income arises from the rights to participate in the activity, rather than direct ownership of the operation itself. The fifth stream is capital gains. Capital gains occur when an asset is sold for more than its purchase price. This form of income is different from the others. It does not appear as a regular payment. Instead, it reflects the increase in value of the underlying asset over time. Growth-oriented companies often generate returns this way. The business expands, profits grow, and the value of ownership increases. When the asset is eventually sold, the accumulated gain becomes realized. The sixth stream is options premiums. Options premiums arise from agreements that grant another party the right, but not the obligation, to buy or sell an asset at a specific price. In exchange for providing that flexibility, the seller of the option receives a payment up front. These premiums represent compensation for transferring a portion of risk or opportunity to another participant in the market. Together, these six streams form the basic architecture of investment income: interest, dividends, rent, royalties, capital gains, options premiums. Every investment we've discussed this season ultimately connects to one or more of these channels. A pipeline partnership may produce income through distributions derived from usage fees. A rental property produces rent. A bond produces interest. A patent license produces royalties. A growing business produces capital gains. And an option strategy produces premiums. Once we see this structure, the investing world begins to look much less complicated. Instead of thousands of investment products and strategies, we begin to see the underlying flows of money. Different assets simply connect us to different streams. Some streams arrive regularly. Others appear only when assets are sold. Some depend on the success of businesses. Others depend on lending relationships or the use of physical assets. Understanding these streams helps answer the central question we've been exploring this season. Where does investment income come from? It comes from economic activity. Businesses creating profits. Borrowers paying for the use of capital. People and companies paying to use assets, infrastructure, or intellectual property. and markets transferring risk between participants. Each of these activities produces payments that flow back to the owners of capital. And once those flows are understood, the next step becomes much clearer. Because building a financial system is not simply about collecting assets, it is about aligning those income streams with the obligations of a real life, the expenses that must be paid, the time horizons that must be supported, the stability required for a sense of financial calm. That alignment is what we will explore next.